I have made millions of dollars in the market by focusing on one thing: liquidity. Every single price move in the market, every breakout, every reversal, every trend you've ever seen, it's all driven by one thing: liquidity. It doesn't matter what strategy you've been using, supply and demand, smart money concepts, trend lines. At the core of it, liquidity is the reason that the market moves. And if you don't understand liquidity, you're not really trading, you're just guessing. Once you start seeing the market through the lens of liquidity, everything clicks. You're no longer confused by why price moves the way it does. You're no longer getting stopped out at the worst possible moments and then later having price continue in the exact direction that you thought it was going to. Instead, you start anticipating where price is going before it even happens, because you understand where the liquidity is. This was the missing piece in my own trading. The moment I mastered liquidity, my entire approach changed. My win rate skyrocketed, my risk to reward improved, and I finally started making consistent money from the markets. Before I was trading using liquidity, I was just using support and resistance, and the second I found out about liquidity, it made sense why I was losing so much money with support and resistance. In this video, I'm going to break down exactly what liquidity is, why it's the foundation of all profitable trading strategies, and how you can start using it right now to take high probability trades. Just look at all of these trades. Every single one of these trades was based on the same core principle: liquidity, and the result: consistent, repeatable profits. So you've heard everybody talk about liquidity, but what exactly is it? In everyday terms, liquidity simply means how easy it is to buy or sell something. For example, if somebody asks you how liquid you are, that means how much money do you have available right now. In trading terms, liquidity simply is just where large amounts of buy and sell orders are sitting in the market. Here's what most traders don't understand. Big banks and institutions cannot trade the same way you do. They aren't entering the market with a couple $1,000s or even with hundreds of thousands of dollars. They're dealing with millions, even billions of dollars in capital. They can't just hit buy or sell like a retail trader. If they did that, their orders would literally move the market against themselves, causing massive slippage and terrible fills. So what do? They manipulate price to create liquidity before they take their real positions. Here's how it works. They're identifying where retail traders place their stop losses and place their entries. The two most common places are swing highs and swing lows. Think about it. When you enter a trade, where do you put your stop loss? Most traders place their stops just above a recent high when they're in shorts and just below a recent low when they're in longs. The banks and institutions push price into these liquidity zones to trigger stop hunts. Imagine the market is trending down and there's a super clear swing high where tons of stop losses are stacked. The big players will push price up into that level, triggering all those stops. This creates a massive liquidity event where those stop orders turn into forced buy orders because people have to buy back their shorts. The big players then use this liquidity to fill the positions that they actually want to get into in the opposite direction. Once all these stops are hit, the big players have enough liquidity to get into their positions and force the price down. Retail traders get trapped. The breakout that they thought was happening instantly reverses. And now, the institutions are in control, riding price in the direction they wanted the whole time. This is why so many traders often feel like the market is out to get them, because it literally is. But don't worry, I'm going to teach you how to trade with liquidity so that you're trading with the big players, not against them. Once you start seeing price through the lens of liquidity, it becomes super obvious why certain moves happen. If you ever see a sudden, explosive move in the markets that seems to come out of nowhere, that's liquidity. I'm going to teach you how to stop getting played by the market and to actually start playing the market the way the big players do. Now, let's go on the charts and break down exactly where liquidity pools form, how to identify them, and how we can trade around them for high probability trade setups. Most traders approach the market the wrong way. They focus on indicators, support and resistance, trend lines, moving averages, but they never ask the real question: what actually moves the market? Your first step in identifying liquidity is to get this free tool on your trading view. This tool is called FXN Asian Session Range by Rob Minty, and I know it says indicators, but this actually is not an indicator. All this is a tool that shows us the open and closes of different sessions. I'm going to show you my exact setting so you can just copy the way I have it. And keep in mind, I live in Florida, so this is based on Eastern Standard Time. If you live somewhere else, you need to set it around your time zone. Here's my start and end for Asian session. Here's my London session settings. And here is my New York session settings. Red is Asia session, yellow is London session, and blue is the New York trading session. Keep in mind, these are Forex trading sessions, so these are when banks in the US are trading and when international banks are trading. The New York Forex session opens at 8 a.m., whereas the New York stock market opens at 9:30 a.m. These are two different things and both are important, and we'll get into that later. But for now, I want you to keep in mind the levels that I consider important when I'm looking at these charts. I look at the Asian high and the Asian low, the London high and the London low, and the New York Open and the New York high and low. The New York Open is the first 15-minute candle at 8 a.m. To mark this candle, you simply go to the beginning of the New York session, you find the 8 a.m. candle, and you mark it out like so. I mark out the entire candle from the top wick to the bottom wick. I want to show you a prime example of liquidity and how if you were using support and resistance, you would have lost a lot of money. So right here, this would be a retail level of support. So you probably would have a, buy order around this level, and you would have caught a little bit of points, which is okay, but you would have missed the big move. And if you had your stop loss below this level, you would have gotten stopped out if you didn't sell right after this little move. Now, the thing that banks look for is they look for untested swing highs and swing lows like we talked about in the beginning of the video. So right here, you can see that we have an untested Asian low right here. So that's where price actually wanted to go, because this is where the institutions wanted to get filled, and they did. They took out all these stop losses right here and then used this to get into their buy orders. There's two ways that you can trade swing highs and swing lows, and I use both of these ways. The first way is just by simply setting a limit order right here and having your stop loss a little bit below the swing low. The second way, and my favorite way to do it, is by waiting a little bit so you can see that price is actually going to respect this level and then entering once you see price start to trend back up. When I'm trading, I am rotating between the 15-minute, 5-minute, and the 1-minute time frame because I'm a scalper, so I need to see the 1 minute to understand what price is doing on a smaller time frame. Scalping simply means that on average, I'm in trades from anywhere from 5 to 15, sometimes 30 minutes. The other great thing about liquidity is that we can use liquidity to understand where price is likely to go, almost like a magnet is pulling another magnet close to it. For example, right here we have an Asian high, and you can see that after we sweep this low, price comes up and perfectly targets this Asian high. Real quick, I'm going to show you an example of a trade that could have resulted in a loss, because remember guys, trading is not all about winning, and if somebody tells you that their strategy has a 100% win rate or even like a 95% win rate, they're probably lying. Me personally, my strategy has around a 65-70% win rate, but I target high risk to reward trades, so the math's out. Like, this makes me a lot of money. I don't obsess over winning every trade. I obsess over getting really good risk to reward ratios so that my losses are small and my wins are big. Right here, you can see that price comes down to a New York low. Personally, I wouldn't have taken this trade because I trade New York session, and this trade happened at around 5 a.m. So honestly, I was asleep when this trade happened. But if I was up, I probably would have gotten into a buy position, and I would have had my stops just below here. And I likely would have gotten stopped out unless I waited for price to reverse. If I waited for price to reverse, I probably could have caught this, but this was a big, fast move. That's the thing with liquidity, is you are going to take some losses like every single trading strategy, but your wins will be really, really high risk to reward trades. So if you take 5-6 losses in a row, which probably won't happen, but if it does, you'll still be good because you'll be able to catch a 1-to-4 risk to reward ratio, a 1-to-5, maybe even a 1-to-10. That same level we just talked about that was swept right here actually turned into another level of liquidity, which then resulted in some really, really nice trades a little bit later in the week. If you're trading during the Asia session, you could have said, okay, this is a really strong level. I'm going to wait for price to test this level and then wait for a few confirmations that price is moving above this level. For example, this could have been a confirmation. This also could have been a confirmation. You could have entered the trade, used this level, and made a lot of money. The reason that most trading strategies, including yours, might be failing is that most retail traders use the same recycled strategies. Breakouts, support and resistance, moving average crosses. But here's the problem with that. Indicators lag behind price. By the time an indicator signals it's time to take a trade, the real move has already happened and you've already missed the prime entry. Sure, you might catch some trades off an indicator sometimes, but you're always late. Institutions are in and you're left chasing, and they will usually win this chase. Support and resistance zones get hunted, as we just talked about. Let's be honest, guys. Price does not have to respect a level just because you drew a line there. To be honest with you all, when I was trading support and resistance, my charts looked like complete shit. I had so many levels and I was never able to identify which of these levels were important and which of these levels were just there. Institutions purposely push price past these levels to trigger stop losses and create liquidity for their own entries. The market does not reward the majority of people. In fact, the market takes money from 99% of people. And since most people use support and resistance, indicators, breakouts, institutions know exactly how to take these people's money. This is why most traders fail. They're entering at the exact spots where institutions are taking the opposite trade. Now, let's compare that to trading with liquidity. When you trade with liquidity, you're not just guessing, you're understanding what actually moves the market, as I showed you a little bit ago. As you start to understand liquidity, you're going to be trading with the actual flow of the market. Price doesn't just move randomly, it moves from one liquidity pool to the next. Once you start to see this, you're going to start to trade like the institutions. Instead of entering with retail traders and getting stopped out, you wait for liquidity grabs. Instead of placing stops where everybody else does, you position them in safe zones where institutions will not target them, which gives you much higher risk to reward setups. Liquidity-based trading allows for sniper entries with super small stop losses and massive upside. Instead of taking random 1-to-1 risk to reward trades, you're catching 1-to-3, 1-to-5, 1-to-10, maybe even a 1-to-15 risk to reward trade because you're entering at these institutional levels. The great thing about liquidity is that it works in all market conditions. Some strategies only work in an uptrend or a downtrend. Whether the market is trending, ranging, or consolidating, liquidity always exists. Big money is always hunting liquidity, which means you always have a framework for finding these high probability trades. The difference between losing traders and winning traders is that losing traders are constantly reacting to the market. Winning traders are understanding the market and even predicting what the market is likely to do before it happens. This doesn't mean that they're always going to be right, but it does mean that when they are right, they have a really high risk to reward trade, and when they're wrong, they just lose a little bit of money. There's three main trade setups that I like to take off of liquidity: bounces, rejections, and break and retests, and we're going to go over all of them right now. The first kind of setup, and the one that I showed you a little bit earlier in the video, is a bounce. We have a level, price comes down to this level, price bounces off of this level and moves up. When we are playing bounces, we are expecting price to move up, which means we're looking for buy positions around these areas of liquidity. Right here is a beautiful trade that I took off of a bounce. So you can see we have the New York low right here, price comes down, bounces immediately off of this low. This is one of these scenarios where I expected price to have a really strong reaction off of this level. So I actually had a limit order right at this level, and then I had my stops already placed. Bam, got in the trade, got out, made a few $1,000s on that trade. Here's another example of a beautiful trade that I took off of a bounce. So this was a trade that I took off of a New York low right here. I took that bounce, bam, got out right around the New York high. Now on to the next type of setups, rejections. Rejections are simply the opposite of bounces. They're when price rejects off of a high, which is where we look for shorts. Here's a really nice trade that I took off of a rejection of this New York high right here. I want you to understand why I took it off of this high, not off this high. This high had already been tested. When a level is tested, it still can be strong, but the untested levels will always be the strongest levels. I recognize that, so that's why I had my order placed around this high and not these highs. Here's another trade that I took off of a rejection of a New York high right here. And remember guys, I am not trying to catch this entire move. Some people like to catch super big moves, and I do that sometimes, but my main goal is to catch a nice move early in the day and then get out and go live my life. The last type of setup that I look for is a break and retest setup. A break and retest simply means that price breaks below the New York open, retests it. Retest just means retouch. Test is just a fancy word for touch, and then continues moving in the same direction that it broke out to, which in this case was to the downside. A tip that I'll give you for trading break and retests is you really want to make sure you're trading when we have volume. I don't usually trade any break and retest setups until about 9:30, 9:45, because this is when the volume comes in from the New York stock market. If you're trading a break and retest before this, it can work, but it's definitely harder to trade. Here's another example of a break and retest. We have our 8 a.m. candle. We wait until about 9:30, 9:45. Price breaks out, we get a retest, price continues moving in the same direction that it broke out to, which in this case was to the upside. I had my take profit set right around this New York high, got out for a nice risk to reward of 1 to 3.5. I'm usually risking around $1,000, sometimes $2,000. On this trade I was risking $1,000, so I ended up making about $3,500 on this trade. To calculate your risk reward, times your risk by your potential reward, right? So I was risking 1,000, I made money, so I made, technically $3,480. If I would have lost, it would have just been a 1, so I would have lost $1,000. Now let's talk about a few mistakes that people make when they're trading liquidity. The first mistake that people make when trading liquidity is they don't wait for volume to come in. If you're trading in the middle of Asia session, it's very likely that there's not going to be enough volume for a real move to happen, unless there's some random news event that causes a big move in price, but you can't trade around this because you cannot predict news. Personally, I like to trade between 7 a.m. and 11 a.m. Eastern Standard Time because this is when the New York stock market opens and when the New York Forex session begins. A key tip here is that if price is reaching a liquidity zone but there's not a strong reaction, it's probably not worth taking a trade. So if you see super low volume and price is just not doing anything when it reaches a liquidity zone, probably not a good trade. A lot of traders approach liquidity with the retail mindset. They think that just because price has respected a level a lot of times, this means it's super important. In my personal experience, I have actually found untested levels to be the strongest levels. If you go back and look at the trades that I was reviewing, pretty much all of those levels were untested levels. Once a level has been tested a lot of times, it becomes very easy for retail to say, oh, this is support or resistance. In reality, this is an area where institutions are hunting your stop loss. Institutions do not care about retail concepts. They create liquidity traps and literally take the other side of your trade. So if you don't start thinking like them, you'll always be on the wrong side of the market. When you trade liquidity, sometimes it'll feel a little bit scary entering because you're entering right as you see a huge move down, but understand, money is made when you buy the fear and sell the greed. These concepts have made me millions of dollars, but the truth is that there's a lot of different parts of my strategy that have made me profitable other than these concepts. Things like risk management, my mindset, how I backtest this strategy, and a few other things. That is why I put together a free video breaking down my exact process that took me from a broke busboy to a multimillionaire trader. Click the link in the description of this video so you can watch my story and see how you can do this for yourself.